9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia Pacific down 0.5%. As you can see in the benchmark, you have tensions between U.S. and Europe over Greenland, sapping risk appetite, gold and silver at record highs.
Investors now awaiting the EU's response to President Trump's tariff threats. Germany trying to convince France to avoid using the bloc's most powerful economic weapon.
Also ahead, Chinese Vice Premier He Lifeng set to meet with global CEOs at the World Economic Forum in Davos as businesses seek to boost ties with Beijing.
And Japanese bonds under pressure once again ahead of an auction of 20-year debt on the government's plan to cut a food sales tax. We start the show with some breaking news when it comes to the LPR's loan prime rates out of China. Well, banks are just setting that both the 1-year and the 5-year unchanged at the moment. So 3% for the 1 year, 3.5% on the 5-year. This, of course, is the one that is tied to the mortgages of China. But certainly we weren't expecting any sort of change here on this front. But certainly, given what we've been seeing, the property market concerns, I think we're hearing more economists chime in and saying they need to do something when it comes to stimulus on that front. But right now, unchanged at the moment. But really, all eyes still turn to Davos and what we're hearing when it comes to Greenland.
Yeah, the fireworks came early ahead of course, the big one, which is, of course, the U.S. president midweek. But ahead of that, of course, lots of jostling taking place. And hence, we are seeing, when you look at markets today, largely most assets are in offer. And we'll get to the precious metals in a moment because, again, silver, last we checked, is up 5%. As you can see, so the KOSPI actually opened higher for the day. And we thought at that point we were up 13 days. As you can see, we're paring back about 1%. And if we do close at about these levels, it would be the first time in 2026 we've actually had a close. We would have a closing day in Korea, but the night is young, and so are most of us. 0.9% of 1%, Nikkei 225 to the downside. So we now have a date on the elections, and on the table will be a potential cutting of the sales tax and what that means for, and we probably showed you this earlier on as well. Let's flash the screen, please. Flip the page, and the 40-year JGB now has a specific handle, highest since 2007. Bottom of your screen's 4% there. We talked about silver, 6%. The dollar is, let's call it trading sideways after really one of the steepest drops on the BBDXY going back a couple of weeks. Dollar yen was above 158. We're now touched below that. So stronger on the Japanese currency. A glance at what happened overnight. China proxies in the U.S. You had obviously the conversations around, is the nationalist team stepping back its supports? In fact, might be doing the opposite as far as offloading some ETFs are concerned, and what that means really for broader efforts to maybe cool what was up until a few days ago an overheated rally. 1.2% on the specific CSI 300 ETF overnight. Golden Dragon Index down about 1%. BABA among the tech stocks in plan in watch today. And I think we are on a 3-day slump on China. Thank you so much. And yeah, among many things. So at 695.70, that would put the offshore exchange rate at the lowest since May of 2023. If you recall this time yesterday, the midpoint out of the PBOC was barely a hair above the 7 handle. We'll see, given the dollar drop since this time yesterday, what that fixing is going to be and what that really signals over the currency, given the levels we're at right now in the exchange rate.
Yeah, so we have seen a series of steps now to try to cool down this China equity market, whether it's from, margin financing. You talk about high-frequency traders right now, and now that you're seeing maybe perhaps signs of the national team also, selling some of their holdings here, you got to wonder, are these measures going to work in terms of taming this rally, or could things actually backfire like what we saw back in 2015 as well?
Yeah, it's a good problem to have.
Yeah, certainly.
Right. We're rarely on the other side of that operation, but certainly yes. I mean, when you look at geopolitics and the news flow out there, they probably don't have to do a lot as far as sapping risk appetite is concerned. We'll get to the havens in a moment because we talked about Greenland tensions in Germany. The finance minister, I believe, saying it is a red line that we're now at. But just very quickly, of course, on the Japanese side of things, we have a BOJ decision this week, don't we?
Yeah.
Yeah. And
haven't even begun to talk about that.
Yeah. And they're not expected to do anything. I think it's keeping the optionality open of when they are probably going to need to raise interest rates without giving it away That is just to say, of course, the story in the bond markets today, and we'll have Jenny Zeng later on to talk us through what the implications are of a 40-year JGB at 4% and whether or not that is value on the table. But this new information, of course, of the sales tax perhaps being taken off the table. But yeah, back to Greenland and why we're in the red, really.
Yeah, we've heard from some voices in Davos already. We'll bring you some of those sound bites very quickly. But we're hearing from the European leaders, of course, reacting to President Trump's tariff threat over Greenland. Let's take a listen.
We are constantly experiencing new provocations. We are constantly experiencing new antagonism, which President Trump is seeking, and we Europeans must make it clear that the limit has been reached.
Blackmail between allies of 250 years. Blackmail between friends is obviously unacceptable. To my knowledge, this is the first time that an economic instrument, tariffs, which we don't think very highly of, has been used for geopolitical reasons.
Alliances endure because they're built on respect and partnership, not pressure. That is why I said the use of tariffs against allies is completely wrong.
Let's bring in our team. John Farr is our senior executive editor for APAC. Also want to bring in Stephen Engel, our chief North Asia correspondent, to talk a bit more about the China angle on all this. But John, welcome to, of course, Hong Kong, and perfect timing to have you on the show about the pushback that we're seeing from Europe when it comes to the threats of tariffs from President Trump. How unified do you think it is at the moment?
Well, I think they're united in shock that Trump has sort of put Greenland on the table like this. But I think if you parse the comments, there's sort of a bit you do see splits and division in terms of how to react to this. So we heard from finance ministers of Germany and France yesterday talking about red lines, talking about blackmail, etc. And Macron was talking about reaching into the European Union's toolkit in terms of trade measures they can take against the US. But then on the other side, you have people like Friedrich Merz, the German Chancellor. You have Keir Starmer, sort of trying to slow things down a little bit. I think the calculus is Trump has backed down from things before. The calculus is that Europe has done okay on Ukraine. That at least they've kept sort of Trump in the conversation around backing Ukraine, whereas 9 or 10 months ago it looked like he would totally pull back from that. So, but I do think they're split. They don't really know exactly what to do here. This is unprecedented. The European Union does not act quickly. And we're going to see, it'll be interesting. The next step, I think, is to sort of wait for the emergency summit of EU leaders that's been called for Thursday.
Steve, how does this line up for the Chinese side, the delegation, not just from the government, but of course you have a whole cohort of business executives?
Yeah, I think the Chinese leadership has been fairly quiet and muted on the ramifications of what's happening between the EU and the United States as regards to Greenland. But that doesn't mean that they're going to try and take advantage of the rift, obviously. We've saw Vice Premier Ding Xuexiang last year at Davos. We had Li Qiang, the premier, at Davos the year before that, and also Liu He the year before that. And they've all meet behind closed doors, invite only, with CEOs, world leaders, and this time maybe even a little bit more pressing as He Lifeng, the vice premier, and also the one really in charge of those negotiations with the United States on the trade front, to sort of court the EU a little bit more, like what we saw as well with Mark Carney, the Canadian Prime Minister last week, go to Beijing, strike a new strategic partnership with Beijing, calling it a new world order, going to be importing 49,000 EVs in an about face, a complete reversal of the policies on the EVs of Justin Trudeau of 100% tariffs. So I think there's going to be a little bit of rolling out the red carpet, and the similar narrative from Beijing is we are open for business. We are champions of a free market economy globally, and that's going to continue because we're also going to have Keir Starmer scheduled to go to Beijing in the coming days, if not weeks, if they can resolve this issue. Today, I think, is the deadline, the issue for the big mega Chinese embassy in London. But that's a side note. But also, Friedrich Merz, the German Chancellor, is heading to Beijing as well. The red carpet and the opportunities are going to be rolled out there.
Yeah, John, maybe you could tell us, there is a whole taco sort of trade that, I think the market reaction, we did see a sell-off, but it's not like people are hitting the panic button just yet. What are the economic implications of all this, for one thing? Obviously, given the fact that, the Germans are very heavily dependent on exports here. They might not be willing to kind of use the bazooka, as you mentioned here as well. But there is a hit to growth potential that we need to talk about, too, if we do see these tariffs play out.
Well, yes, I think Bloomberg Economics estimates that the hit to European EU exports to the US would be 50%. If these tariffs, if the full sort of scope of these tariffs, 25%, comes through. So there's that. And then there's also just the general sort of ongoing grinding uncertainty about where where trade relations, if you're a European businessman, and you could say this if you're an executive anywhere in the world, what is this actually going to look like in like a year's time, 2 years' time, 3 years' time? And that sort of hit to uncertainty impacts on investment decisions. It impacts on all kinds of future-looking, investment opportunities that you might be thinking about. So there's like the real-term, tangible, short-term impact of 25%, an extra 25% on tariffs, and then there's just the sort of lingering uncertainty over business sentiment.
Steve, this revolving door of policies, the delta at which the policy outlook is changing in the U.S., how has that opened the door for global executives looking at China, looking to strike quietly deals at Davos?
Or not so quietly. I was there in China when Mark Carney did his deal, as I just talked about. He was not quiet about it at all. Of course, Canada has taken it on the chin from Donald Trump, and Carney's sort of pushing back quite strongly, as evidenced by this deal in Beijing. But again, Beijing really sort of papered over the deep fissures in the domestic economy by boosting exports. They've been able to do that, 6.1% growth in exports. And this perhaps dispute between the United States and Europe sort of buys Xi Jinping some time to get the structural problems, addressed. But again, I don't think Beijing really wants to see any kind of military conflict. The shock waves would reverberate around global trade, and that would definitely impact Beijing and its reliance right now, given the domestic consumption story economy is so weak. They would absolutely need to continue to see export growth. Any kind of military action globally, whether it's Greenland, Iran, or elsewhere, is going to hurt the Chinese economy. So they have to play this very delicately. Surely they're going to be continuing to court those from Europe. The Global Times is weighing in on this.
There was an article this morning on that.
And the headline essentially says, Europe's biggest problem is perhaps an inability to distinguish friends from adversaries. So that is going to be kind of the wedge, I think, He Lifeng is going to... He's a negotiator. He's a friendly, more affable face of Beijing. He'll do it. He'll use that wedge, but in a softer way.
Fantastic. Thank you so much. John, thank you. Steve, thank you so much. By the way, for Bloomberg clients, you can check out, I think, from about mid-afternoon Asian time today, we have a lot more on our coverage on Davos. Of course, CLI Vigo is the function you run, and we get started in a couple of hours or so. Stay tuned for more of that coming through as well. Coming up here on shows.
We're going to hear from JPMorgan Asset Management. They believe that China is well-positioned to lead this year's AI evolution. But really, you take a look at Korea and the like, they certainly have a lot of conviction in that market as well. Plus, his top conviction calls around the region is up next. We're counting on the open of trade in Shanghai, Shenzhen, and Hong Kong. We're seeing futures here right now this morning. Looks to be heading lower here as we start to see the risk-off sort of trades filter through here in the Asia-Pacific here. Another day of sell-off, it looks like here, or flat at least right now. This is the China Show.
Almost there, but not quite. So you have 3 zeros on the back of this decimal point on the fix. So we're not just there just yet, but effectively we are trading. Well, the fix is at the strongest level since about 2023 mid. And the exchange rate is also at about that level, May 2023 levels on dollar offshore. Flat to slightly lower on futures going into the open today.
Maybe we'll see another, tomorrow. They'll just set something below 7. But certainly at this point, it's just very psychological at this point. You take a look in terms of your agenda here today. Some key briefings to kind of watch out for. There's an NDRC one and a finance ministry briefing. One's at 10, one's at 3. So we'll bring you the latest once they come through. But anything to do with policy in terms of stimulus and the like is certainly going to be key sort of things that investors are going to be watching out for. Metals and miners, we talk about silver once again hitting another record here as well. Hong Kong listed Korea ETFs, just given what we've been seeing when it comes to Korea has kind of been dancing to its own tune up until maybe today, and really continue on with this rally that we saw last year. The national team, right? So this might be the next sort of signs of policymakers really wanting to cool down this equity rally in China here right now. In terms of deals and the like here, we're watching potentially here China Tourism Group, the duty-free to buy the DFS stores in Hong Kong and Macau. There's been some, Pop Mart as well, buybacks, certainly that's one to watch as well. And that Yuan fix, as we talked about just now, Dave.
Yeah, lots on deck today amidst really, given the news flow out there, it's really been quite surprising to see how risk assets have actually held up, right? You look at Korea, for example, which I think up until today has yet to close lower for the year. China's done okay as well. I think we're up 3 days, and down 3 days for MSCI China. But I think when you look at HS Tech, that's really continued to outperform. Joining us here to talk us through, to get us started with the market dialogue today, Alexander Treves, JPMorgan Asset Management's head of investment specialist for APAC Equities. Good morning. Very nice to see you. Happy New Year.
Morning. Happy New Year.
So Chinese markets, what's top of mind? What's the first thing that comes to mind when someone brings it up?
Well, the first thing which comes to mind right now is the balance of GDP growth. Because China's achieving the sort of the broad GDP growth number that they want. The really interesting thing is the composition of that. And if we think back, the story for China is meant to be this shift over time away from China being the workshop of the world to being a domestic innovator with its own domestic markets. And the innovation piece is working. The consumer, much less so at the moment. And so quite a lot of the driver of growth out of China has been exports. Now, people tend to think about exports in terms of what China sells to the US, and that has come off for reasons that we all understand. But China's done an outstanding job of repositioning its export sector to other markets. And so what we would like to see actually is the consumer recovering their vigor.
Yeah.
And the economy being more domestically driven.
Yeah, and the equity market is still quite divorced in the fundamentals, it seems, because it seems like it's AI and
non-cyclical
that are really kind of carrying this equity rally here. Can it continue to do so without massive stimulus?
Well, I would respectfully disagree with the equity market being divorced from fundamentals.
Okay.
If we think back a couple of years, we had this slightly bizarre narrative about China being uninvestable, which was always nonsense, but it did mean a lot of people weren't looking at the market. So China's rise has been partly, the equity market's rise has been partly just a recovery from an oversold position, which is justifiable. That's a good thing. Now, within the market, there are certainly some areas of strength, and it's maybe a little bit narrower than we would like. The AI thing is interesting because partly that feeds into global AI, which is one conversation. Partly it feeds into domestic AI in China, and the self-sufficiency story is a totally different narrative.
So what are the best, let's call it, tactical opportunities in the Chinese market now?
Well, you know that I'm going to tell you always to be a long-run investor.
Yeah,
but having said that,
I'm very impatient, though.
Having said that, clearly we've got the tech self-sufficiency story, and that's not going to go away anytime soon.
Okay.
We've also got idiosyncratic stocks in export markets, and China's able to carry on growing its export share of a whole range of goods, which people don't sort of typically think about.
Right.
And then, of course, we've also got a bunch of things like, within the internet space, we've got some very, very serious business models there. The slight question being, can they get over price competition and use things like AI to drive their own cost base and revenues, et cetera?
How much interest are you getting from foreign investors for this market when I look at the rest of the region where seems like there are better, safer places out there? When I look at Japan, fiscal stimulus, I look at Korea, which continues to kind of fire this rally. Is the China sort of story still attractive to a lot of foreign investors
Absolutely.
out there? Yeah.
So we get various streams of interest, and it depends slightly how clients are positioned.
Yeah.
But the overall narrative is a lot more interest in Asia as a region, partly as they want to diversify out of the West and the US in particular.
It's the risk then based on how that was phrased. If the dollar strengthens, what happens? What happens to Asia, this long Asia trade?
So a weaker dollar is undoubtedly good for Asia. And what's so interesting right now is that typically in a period of higher risk, higher volatility, higher uncertainty, that results in dollar strength. Now, that only works, of course, when the US isn't itself the originator of the uncertainty. And I think a bunch of us would agree that some of the policy pronouncements are causing people to sort of just say, well, do we need to diversify a little bit more out of their existing US dollar holdings or their US holdings? And the US market is very widely held already. So in terms of who the marginal buyer is, that's not entirely clear to me, whereas lots of people can buy Asia at the margin.
Alexander Treves will be staying with us, of course. Lots more to talk about with him. He's with JPMorgan Asset Management. Just staying with us here. A glance at the JGB market, and you probably see one of rising yield environment today, in fact, quite substantially. 7 basis points into 10, about the same on the 40-year yield, which is now at 4% for the first, that's a nominal level, of course, first time since 2007 on that. Feb 8th, mark your calendars now. Those are the much, I would say, early, clearly flagged elections coming up, but certainly the market's already positioned around that. The new thing, though, is we need to talk about the sales tax and what that means, of course, for fiscal discipline.
I think that's what's really sending long end yields a bit higher here. She's officially the PM called for that election on February 8th, and also here, of course, we have that 20-year JGB sale that's happening later on today as well. We've got plenty more to come. Pre-market in Hong Kong looking like this here right now, slightly flat, slightly lower. This is Bloomberg. Hang Seng pre-market, we mentioned, has been flat, but there have been some interesting moves here so far when it comes to China duty-free units. So they might buy DFS Hong Kong as well as Macau assets as well. We're watching very closely what happens with New World Development here. The shares basically saw a surge on Monday amid support from possibly that the company's parent may boost its support for the developer here. And PopMart, there you go, seeing a pop here today. They're buying back some stock, some shares, I should say. First big buyback since 2024.
Yeah, nothing too mysterious about that one. 5% to the upside. Also nothing too quite understandable. The move you're going to see next is, this is down to precious metals, of course. I think 95 is where we're trading on silver. Gold is ever so slightly flat, side to the upside. 93, I'm sorry. We were at 95, and then we were at 89, and we're back to 93, which I guess also tells you a lot about this. UBP is joining us, by the way, at the top of the next hour, and they have, I think they've revised higher their call on silver, still below the current levels, but we'll see what they say about especially the ratio as well going into today. Right, in case you missed it, the loan prime rates were out, 1 and 5, unchanged there. And we are going into the open today on a 3-day losing streak on MSCI China. The turnover onshore did again top 2 trillion renminbi. That was on Monday. Going into the open today, 0.2%. BABA was down 3-4% overnight. And of course, the other conversation, which we'll get into in more detail next, is really what the national team, based on flows data around the ETFs, have been doing or not doing, given the broad acceptance that is maybe they're trying to cool the slow bull market. That and more, plus the open, just ahead. Welcome back to watching the China Show. So lots on deck as far as the complex, moving, multi-aspect conversation around Greenland and Davos, and stronger language coming through from the French. If you look at the German finance minister calling what the U.S. has done, we're now at a red line. But it's still a very fluid situation. And, of course, the divisions within Europe going into the speech from Donald Trump.
Yeah, you had the German chancellor seemed to have much, I guess, a bit more conciliatory tone than what the Finmen had to say, really just saying that they are still trying to work on that. They're trying to, at least calm the French, at least, that are talking about these anti-coercion instruments here, the bazooka. Yeah. So can we see cooler heads prevail here? And really, there is this assumption that maybe Trump was just doing this for some sort of deal, right? That maybe he will back out. So markets did panic. Obviously, you saw the European session was hit hard when you see some of the sectors that were exposed to the U.S. here, luxury cars alike, that did take a hit. But it's not like it was a panic selling. Yeah. Euro was also actually up during our Asia session. So certainly there is some cooler heads in this market as well. And you actually are seeing, is Asia that safer play here? And you're seeing that slightly when it comes to Chinese markets here. Onshore, we're still seeing some green, but we're calling it flat. You talk about what we've seen when it comes to the national team. We'll get Rebecca Sin from Bloomberg Intelligence to tell us a bit more about what we've been seeing here and what the national team has been doing in terms of their holdings. But certainly right now, the get-go, it's low conviction. But yes, it seems like things are, relatively speaking, looking a bit more calm onshore. Obviously, the big really rally we've seen has been in some of the small caps as well, which actually have outperformed the likes of the Shanghai Composite as well, the CSI 300 so far this year. Take a look when it comes to Hong Kong. Obviously, there's been some talk about these briefings and what we could see, and whether there's some sort of kind of forward-looking sort of message that comes through from regulators as well as the finance ministry here today. Those briefings are set to hold here, one at the top of the hour. So we'll bring you the latest once we get that. HS Tech, though, is slightly on offer. You take a look at how Baidu is looking. We're down some 3.6%. That might be the bigger drags here, but Alibaba and Tencent both in the red here this morning. That fix from the PBOC basically was just flat on 7 right now. But given the dollar moves, the weakness that we've seen, we are seeing a bit more strength in the currency at 695 levels here this morning. But the property sector looks pretty good. I think the New World sort of story yesterday was quite interesting. We saw quite a massive move in the stock there yesterday on signs that maybe the company's parent is willing to help out. But in terms of what we're watching in stock moves, Pop Mart is one thing. Last week, there was all this kind of concerns about labor exploitation. There was this BBC report. This time around, potentially now a buyback now. And so they're saying that the first buyback since 2024, that's really kind of lifted the stock here. We're up close to 8% here right now. Morgan Stanley is saying, yeah, a potential catalyst here. It's
a positive for shares. The national team also in focus, given, I think, our research out of Friday. We'll get to that in a moment. Well, let me take it 2 steps back, right? A few days before that, the regulators came out and raised the ratio on margin financing, number one. And, of course, just broader efforts to maybe stem what, according to Morgan Stanley, I think Laura Wang joined us a few days ago, right? In their mind, I think as early as the first week of the year, there were already signs of the market was overheating, right? So they were coming in to cool the market. And one of the things that we looked at here, which we'll get to very, very shortly, is that maybe the national team's taking a step back from these ETFs that they did use, of course, to support the market. Now that the market's doing well, maybe it's the opposite. In fact, have a look at the chart and how that looks, right? Outflows out of China ETFs. We have data on this. And as you can see visually on the right side of your screen, that's quite telling from a flows point of view. And yes, in fact, let's talk more about this, exactly what we're seeing. And joining us here on set is Rebecca Sin, our Bloomberg Intelligence analyst, on how much has the national team actually sold, is a question.
So on Thursday, they sold a record $10 billion worth of ETFs, and on Friday, $15 billion. And so you may recall that last year, mainland China surpassed Japan in terms of assets under management. And now, China is number one in terms of assets under management across Asia Pacific. They have roughly 900 billion assets under management. And last year, they bought roughly 200 billion in ETFs, mainly a lot from national team. A lot of that flow was national team. So they bought ETFs at a record speed. And now they may sell at a record speed. And so if you look across 2 days, roughly $25 billion worth of ETFs has been sold. And as you saw in the fund flows chart, this is a record number.
So if they were to continue at this pace, how long would it take?
It would only take them 16 days to sell. And so if you look at where we are right now, they could sell all of their ETFs holding right before Chinese New Year. And so we don't think that that's a coincidence. As you said earlier, the market has been overheating. And on Thursday, they only sold in the tech sector, so mainly the Star 50. And if we look at where the Star 50 is versus the CSI 300, Star 50 is up almost 12%, a little bit more than that year to date. And so oftentimes they use ETF as a sign to cool the market or to support the market. And so last year, they were using ETFs to support the market, to prop up the market, and now they may be using ETFs to show investors that it may be time to cool off. And we think that strategically they picked the tech index first. Tech is ultimately one of the highest sectors across China, but ultimately a lot of they don't want retail investors to pour so much money into it, and so they're using it as a sign to say, look, we want to cool it down. We're slightly worried that it might be overheating, and so we've started to sell into this.
Before we talk about the landscape across the ETF market, China, Hong Kong, can I just ask, do we know what they did yesterday? On Monday, did they sell? Do we have data on that just yet?
That data is coming in right now this morning, so we should know about lunchtime. Yes. But we expect that they may continue selling, mainly because they've ultimately used ETFs to show indication to the market of what they want to do. And so that's why, based on our estimate, they've never sold this quickly. And if we look across all other markets, Bank of Japan has started selling ETFs as well. But as you may recall, they amassed ETFs over 13 years, and they now own more than 80% of the market. But at the rate that Bank of Japan said they're going to sell, it's going to take them more than 100 years. So if you compare Japan, it's going to take them more than 100 years, and China, 16 days. That's a record number, and so that's just how quickly they can move.
Okay. Just to split the difference there, I want to ask you about Korea, because Korea has a very big representation, the Korea theme in Hong Kong, right? You have a lot of the leveraged ETFs, inverse and otherwise, and Samsung, for example. How have you been tracking the data there? Because that's really been a
so we
circus. for retail investors.
Of course. Korea is ultimately one of the best performing, if not the best performing sector in 2025. We had the KOSPI up 75% in terms of performance. So, of course, ETFs did really well. Because of that, South Korea's ETFs assets under management has surpassed Australia, making South Korea fourth in the region now. And so if we look at the Hong Kong market specifically, CSOP launched the leveraged inverse SK Hynix ETF last year, and they've seen record inflows into this. Because Korea has performed so well, and year to date, Korea KOSPI is up, I think, more than 10%. And so a lot of people felt like they missed out last year and that, now's still an opportunity. So a lot of people are using the leverage and inverse ETFs to express views because ultimately Korea has done so well. They want to get double, triple the inverse. But in Hong Kong, we don't have triple, we only have double. And so SK Hynix is one of the good indicators that we've seen a lot of flows going into this.
All right, Rebecca, thank you. Rebecca's in there from Bloomberg Intelligence, really tracking where flows are in the ETF market and really how the landscape has changed. 16 days, that's all it takes for the national team to sell. Still with us is Alexander Treves, JPMorgan Asset Management's head of investment specialist for APAC Equities. Rebecca talked about how hot Korea has been. I mean, near 80% gains last year. How do I position this year around Korea now?
Well, look, remember that Korea rose vertically, vertiginously, whatever the word is, off a very, very low base. And Korea has always been cheap. For the 29 years I've been looking at it, Korea has looked cheap, generally for a reason, because returns are quite low. Now, various things came together last year. First was the AI tech hardware supply chain and the way that spilled over into commoditized memory more broadly. You've got the whole the defense story and the plays around there. And then you've got value up and corporate governance and what that means for fair valuations. Anytime a market goes up as much as that, it's entirely possible that you will see a pause for breath at some point. And if there was a period of consolidation, that would be entirely natural. But as long as those fundamentals keep improving, as long as you see, again, robust AI supply demand growth, as long as you see, crucially, the value up program persisting and ROE going up, then over time the market should carry on improving.
How would you describe valuations right now? Because it's always been cheap, and you could argue it's simply, I want to say reverted to mean, because it's been cheap as in its previous life it was cheap. Do you think the market's re-rated enough that we should value Korea a lot more now in terms of how we should attach multiples to this index moving forward?
So what you need to see is you need to see ROE continuing to go up. And as long as ROE approaches the levels that you see elsewhere in the region, then price to book will also carry on going up. So that's really what you want to see. At the moment, Korea doesn't look expensive to us, but the valuation could move around from here. But what we really want to see is that sort of structural, longer-term improvement. And we're still waiting for some of that to come through.
Okay. Where are you seeing that value-up program being pronounced, or at least being reflected? Are there particular sectors where you're seeing, balance sheets are being optimized, they're selling non-core assets, they're unlocking value? Are there particular areas and pockets of this market that you're seeing that more meaningfully now?
Sure. Well, so the banks have stood out, for example, for some of that. And then, to some extent, the chaebol, you've seen some sort of clearing of the corporate structures there. But ideally, we'd see it spreading across the entire market. The big tech hardware companies, they've kind of got their own dynamic at the moment, but we're also looking to see just how they pay out dividends, buy back shares over time, etc., how they reinvest their capital.
These various value programs have somewhat taken a backseat in terms of just attention because of AI, right? And I wonder whether that's the unspoken, that's the underappreciated theme that investors should be looking at, because you mentioned Korea has it, Japan has it, to some extent China has it with their SOEs, and I think parts of Southeast Asia also are embarking on their own efforts to not prop up the markets, but just sort of governance reforms.
Sure. I mean, corporate governance is just about companies looking after their minority equity investors by generating higher returns and behaving sensibly. And we're never going to complain about that. And as you say, we're seeing this increasingly through the region. So Japan, to some extent, led the way. Korea is catching up at the moment. In China, we'll really need to see what happens as growth reaccelerates and how companies choose to reinvest in growth versus maybe buying back stock or paying dividends or whatever. And then in Southeast Asia, Singapore stands out for the quality of corporate governance. We've got the equity market development program there, and the measures the government is taking to try to increase liquidity, get more issuance, and broaden investor interest into mid and small cap stocks, which is something we're very interested in.
I mean, there's a lot of, I guess, optimism around Japan here once again, just given that there's a new prime minister. She seems to be very Abe-like. The equity market seems to really kind of be reflecting this, but can they continue to rally given how weak the yen is getting right now? Is that correlation still a good thing? Weaker currency, stronger.
Yeah, to some extent. I mean, the yen weakening in and of itself doesn't undermine the story for Japan, given how large a part of the market comes from exporters. But of course, we want to see Japan moving beyond that towards a lot more of the domestic plays and the tech uplift plays and all of that sort of thing. Maybe the real question around the currency is at what point weakness would signal some broader issue. And it's slightly mystifying why it is as weak as it has been. Yeah. But we think the underlying story for a lot of the companies continues to get better.
I think one of the risks that you flagged in a previous segment was if the dollar strengthened. That's one risk to watch. The other one I'm looking at that's been flagged is a major geopolitical event.
We've seen a lot.
Well, we've seen a lot. And I was going to say that given the new normal of optionality around sovereignty as a good example, what would constitute, in today's terms, a major geopolitical event that disrupts markets?
Well, most geopolitical news flow feeds through the market fairly quickly. It dominates headlines for a couple of days or for a week, and then investors forget about it and move on to the next thing. And equity markets are going to digest that, and it's not a problem. Every so often there's an event which takes things beyond that. And I think it's something you should never rule out. So maybe the answer to that is you diversify, you make sure that you're buying high quality assets, all the sorts of things that we know about. And I think that putting more money into Asia, which I would say is relatively insulated from quite a lot of the geopolitics right now, would not be a bad way of handling that.
All right, fantastic. Alexander Treves, thank you so much, sir. Head of Investment Specialists for APAC Equities at JPMorgan Asset Management. Just ahead, we'll get the outlook, just maybe continuing the theme that we just finished there. Precious metals and the rates markets, particularly the former there, amid these fresh geopolitical stories coming through as well. UBP and Allianz will be joining us in the next hour. Much more ahead here on The China Show.
Too early to say what exactly the impacts of new trade tensions is, but we know that when we have more uncertainty, bad for business, bad for households. The best way forward, find a path to agreement. And that is going to be good for everybody, everywhere.
IMF Managing Director Kristalina Georgieva there speaking to Bloomberg at the World Economic Forum in Davos. We also spoke, by the way, with Franklin Templeton CEO Jenny Johnson, who discussed investing amidst everything that's going on.
Volatility is opportunity for active managers, right? And so, look, this administration has shown us that there are surprises around the corner, and so you have to position your portfolio. Franklin Templeton, we have clients in 160 countries. We're going to celebrate 80 years next year. We've been through a lot of administrations. Our job is to make sure our clients have their investment portfolio that is really diversified so that they can actually take these kind of short-term shocks. And if you do it right, you can get through it. And I think, in the case of President Trump, look, think about what the markets did after Liberation Day. We were all looking, oh, my gosh. And you know what? We came out pretty okay on the tariffs. China, it was going to be 100%, right? The markets reacted to that. A little less. You got through that. I think we'll get through this latest.
Is this because the U.S. economy is resilient? Or, the world economy is resilient? Or
well, it's both that. And believe me, I think AI, we haven't even begun to see the impact of AI on individual companies. I think the next really exciting thing is the companies within sectors that actually get it right. They will take off, leaving the others behind in that sector. And so right now it's been the picks and shovels that have really been the ones that have gotten the evaluation advantages. It's going to be those companies, and it takes time for them to figure it out. So that, of course, is part of the volatility. I think the other thing is...
Jenny, is it productivity that they work on, or just in general, like spending to upgrade their systems?
It's going to be hugely transformative in the productivity. And by the way, you actually have seen in the U.S. companies, for a decade, productivity was running at about 1%. We're now closer to 2%. It's massive, which is why I also think you've seen not so many jobs created and yet companies growing, because we're getting, there are 157 million people working in the United States. We've had a 1% productivity. That's 1.5 less people that you need for the same kind of growth. And so definitely AI productivity. And I don't think that's in the numbers yet. I think that the productivity gains are from the technologies that have been kind of the last decade, cloud servicing, other things, digitalization. So the AI, it's going to take time. And there's going to be winners and losers in it. But the pace of it is so dramatic, faster than even I thought it would be.
That was Jenny Johnson there, the Franklin Templeton CEO, speaking with Bloomberg's Francine Lacqua in Davos. Just happening right now, just some live pictures out of Hanoi, where we are hearing from the Communist Party chief, To Lam there. He's just delivering his sort of address, really kind of talking about the vision for the next 5 years. And when he talks about the growth target, they reiterated it's going to be 10% for 2026 and 2030. And we're watching very closely here, what else he says in this National Congress, but really kind of talking about foreign relations, needs to boost foreign relations as well as security. This Congress coming at a pretty crucial time for the country. They're negotiating, of course, a tariff deal with the U.S. They're also trying to balance relations with China as well. So this is an opportunity for Lam to really solidify the changes he's pursued as party chief.
Yeah, so we'll have more from what's happening on the ground. We'll bring you guys more updates. This one has, of course, just begun and just started. Live Go is for our Bloomberg terminals if you want to continue to watch what's happening there in Hanoi specifically. And a bit later on in the show, of course, we'll have more from what's happening on the ground there. So, of course, check that out, LIVE Go on your Bloomberg terminals. Let's talk about Yidu Tech. That's a Chinese medical device, medical data intelligence platform. Well, the company says Beijing's supportive regulatory stance and market size are actually boosting the development of AI in healthcare. So the founder and chair, Gong Yingying, spoke with us at Davos about the DeepSeek impacts on the specific sector.
Last year, when I was in Davos, there was the DeepSeek moment. And before the DeepSeek moments, Yidu was actually building our own healthcare foundational model. And at the time, we actually thought there is going to take us another 3 years, billions of RMB investments, so we can use our own foundational model to create Dr. Copilot. But luckily, we had our DeepSeek moments. And this year, we've been so busy deploying DeepSeek, Qianwen, together with our knowledge graph and also our own healthcare model. And one use case we have is the doctor's agents. So we provided the AI agent factory to the hospital. And then we create agents with the top hospitals, doctors. And now that just after a year, some of the hospitals, maybe more than 50% of the doctors would be very, very comfortable to have 3 to 5 agents working for them. Some does tumor staging, some does patient education, some does sorting out their disease data set, doing timelines and sorting out the EMR records for very long NCD diseases patients.
We're seeing the health tech space in China really booming. What's behind that? Is it regulation? I mean, how are regulations versus the US? So in China, I think there's we have been very lucky that we have a very, very big market. When Yidu launch our products and we go to our clients, hospitals in Beijing, and they look at our product and they probably don't like it. But then we take the same product, so okay, maybe we'll sell it to Chongqing. And then if we get very unlucky that the Chongqing hospital don't like it, okay, we'll go to Shenzhen, and someone would like them and say, okay, maybe let's modify, let's work together, and then we change our products, and then we're able to sell to the entire country. But is the regulatory environment supportive?
Yes, very supportive. The government has launched a lot of policies supporting AI plus, and healthcare is one very big sector. And also we have an aging population problem, and also 2030 Healthy Together policy. So those policies are encouraging entrepreneurs to do business.
And that was the Yidu Tech founder and chair lady Gong Ying speaking in Davos with Has. We just have some breaking lines coming through when it comes to Japanese local media. So Kyoto is now reporting some numbers when it comes to Chinese visitors to Japan. Fell 45% year on year last month. I guess that's not a surprise, just given the fact that you have seen that spat between China and Japan. Tourism obviously has been impacted by that. But yeah, still a pretty staggering number there, 45% lower.
And it's even more surprising given how incentivizing.
It's peak time to go to Japan.
Yes, and the currency, actually, one of the conversations around the
weak yen,
weak currency against the yuan, right, is it might actually. So the last time I think the Chinese yuan was this strong against the Japanese currency, China revalued the yuan back, I think, in 2016, if I remember correctly. But not that that's on the table right now, but we are at that extreme, of course, of incentives to go into Japan. But yes, 45%. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. So, of course, session lows here right now. We're down about 0.5%. We are expected to see this NDRC briefing that's happening at this hour in Beijing. So we'll bring you the latest news, if we get any, on what the policy sort of agenda is looking like here today as well. But moving forward, I mean, it is a bit foggy, I would say, I think, when it comes to
the weather or the general outlook.
I don't know.
That's
what I was going to say. I was going to tie it into kind of how people are looking at all this geopolitical uncertainty, whether it's with Greenland. Certainly, you have seen the Europeans overnight speaking, and there has been some pushback, but I guess there is some split in terms of really what's the next response to really counter these threats from President Donald Trump on talk of EU tariffs. So there is that sort of risk off sort of feel that you're seeing in most markets here today. Precious metals, though, that continues to fire on all cylinders here. So we'll be talking to Peter Kinsella there really closely from UBP about what this all means and whether it is still able to chase this rally. But yes, the markets are looking a little bit more kind of the same from yesterday too, right? Risk off, dollar weaker, and the like.
Yeah, and precious metals, right? As we were talking about there, we're losing track of where silver is on any on any given market check, right? So if you're keeping track, we usually do a market check every 30 minutes, and from one to the other, we go from 88 to 93 to 96 on silver, back to 89. I'm even afraid to look at where it is right now, which I guess I'll be forced to do in a moment. So there's that part of the story. Just very quickly, just speaking of geopolitics, right? A few minutes ago, we got a reminder what that looks like tangibly from an economic standpoint out of Japan with Kyodo News. We'll talk about Pop Mart in a moment. Kyodo News reminding us this 45% drop in tourism arrivals into Japan from mainland China in December. I think the last read was 3% gain in November. That's according to one of the official data sets, which I'll get to in a moment. But 45% is quite deep. Dollar off CNH JPY, to be more specific, coming up on your screens now that's a reminder of two things, right? One is how weak the yen has gotten, not just against the dollar. We focus on the dollar. I get that. But let me somewhat correct myself from earlier on. On an absolute level, this is nowhere near, this is much higher than 2015 levels. The delta, though, in CNH JPY going into 2015 was what some analysis pointed to, that then leading to one of the factors leading into that August 2015 somewhat devaluation of the Chinese currency. Not that we're there just now, but it certainly brings up intervention risk, certainly now more from the Japanese side. Dollar, Indonesia. Yes, here we go. Okay.
Here you go. It's a breaking news now. We're basically hit record lows for the rupiah here. We're trading just below that 17,000 level here. So this is on the report that we saw, right? That the Indonesian President Prabowo is nominating his nephew to join the central bank's board of governors. So the likes of Pepperstone has kind of reacted to saying, this does in some way risk blurring the lines between fiscal and monetary policy further. So, of course, central bank independence is in question there. But yes, optics-wise, may not look too good, they say. when it comes to Indonesia.
Yeah, we've taken out the previous high on dollar Indonesia at 16,957. We're now at 985. Something to watch. Southeast Asia, of course, Vietnam will continue to track that this hour, given, of course, what's taking place in Hanoi. But yes, it's really all about geopolitics and governments and Davos tensions, and I think the point Yvonne was making, right? So will Europe come up with a unified stand? And what that pushback looks like. Certainly in rhetoric, it does seem the firmest we've seen so far. But it's also who you ask in Europe.
United in shock, as John Fryer very nicely said, but split when it comes to the response overall. But it's interesting, right? You talk about the market impact. I mean, the European investors are what? They hold $10 trillion of U.S. assets. Right? When you come to treasuries, you talk about bonds as well. I think they're the largest holder of U.S. treasuries and larger than the likes of China and Japan combined, right? You have the likes of Deutsche Bank talking about this weaponization of capital. Obviously, that's an extreme scenario of whether they can actually, if they will actually sell U.S. assets in the face of geopolitics. But certainly, there is maybe a bit more incentive now to maybe hold off on really adding more dollar assets at the moment, too.
Yeah, and it's also a question, I guess, to your point, that the market has traded on this in the form of, when you look at defense stocks in Europe, for example, right? And I think as a whole, that cohort of European equities, I'm not sure specifically what the technical indicator is, but it's the most overbought in years. Yeah. And I think one of our stories actually has that chart for you. Just underscores this broader, more predictable theme. A theme that perhaps is here to stay, and hence this move into precious metals. That seems to be another aspect of that. And we are hearing, of course, we have heard to the point where we're making from European leaders reacting to President Trump's tariff threat over Greenland. Have a look.
We are constantly experiencing new provocations. We are constantly experiencing new antagonism, which President Trump is seeking, and we Europeans must make it clear that the limit has been reached.
Blackmail between allies of 250 years. Blackmail between friends is obviously unacceptable. To my knowledge, this is the first time that an economic instrument, tariffs, which we don't think very highly of, has been used for geopolitical reasons.
Alliances endure because they're built on respect and partnership, not pressure. That is why I said the use of tariffs against allies is completely wrong.
We do not want this escalation. We do not want a trade dispute with the United States of America. But if we are confronted with tariffs that we consider inappropriate, then we are in a position to respond. And that is precisely what we will be discussing in Brussels on Thursday.
Okay, year to date, currency markets, stronger dollar slightly. That's from the cutoff, of course, 25 to 2026. It's the absolute level, of course, you want to pay attention to. Dollar China lowest there since May of 2023. We are just getting further lines coming through here out of the Japanese that they are continuing to track these currency moves with a high sense of urgency. If they tracked silver, they would have perhaps have an even greater sense of urgency, if not beyond that line. So silver this year is up 32%. So that is not normal, right? When you look at something like this, and we're barely into January. Joining us here on set to talk us through FX and commodities and what do we do with silver if you haven't got an A, if you own it, do you add more, do you reduce? Joining us here on set, Peter Kinsella, Global Head of FX Strategy and Head of Investment Services UK at UBP. Good morning. Very nice to see you.
Thank you. Good to see you.
What a time to be alive with silver prices 32%. What do I do with that information, sir?
Well, you don't buy it at current levels, that's for sure. I think you'd want to be pretty insane to buy silver, given 50-60% rally since literally 2 or 3 months ago. But more so when you look at the volatility profile. Implied vol 65, nearly probably 70%. So if you're buying at current levels at what's already an all-time high for many, many years, on top of that vol profile, you've got to be very brave to do so. I think the fact that we saw the US, the Section 232 report last week, not move to implement an export tariff on silver is a pretty big deal. And certainly what we've seen in recent months, big, huge increase in US stockpiles, it strikes me now that those stockpiles are likely to flow elsewhere, in part, thus reducing global leasing rates somewhat. And I think that certainly the narrative about a significant shortage in physical silver probably doesn't stack up when you do the maths on it. So we're at the moment where clearly silver's beta to gold has kicked in a very big way. I think it's more of a re-rating story for silver, but to go much higher from current levels, you basically have to assume that the gold-silver ratio goes to like 40 or 30, which is stupidly low. From a historical level of historical averages of roughly 65. Right, so
on the ratio,
correct.
Okay.
Yeah. So if we see, for example, gold, continuing on a modest upward swing towards, say, $5,000 per ounce by the end of the year, and you assume a modest increase in the gold-silver ratio, it gives you silver roughly current levels by year end. Right. So I really struggle to buy silver at current levels.
But gold, you say, could still be a buy.
Oh, for sure, no question about it.
Okay, why?
Well. Look, if you think of what we've seen in the first 3 weeks of the year, right? A kidnapping of the Venezuelan president, now threats about Greenland, etc. We've entered an era of, I would say, very clear resource nationalism between the major powers. We're seeing that explicitly in Venezuela, next up in Greenland. And what it tells you is that this geopolitical theme can move at any time. And, currencies are not necessarily the best way to play it. The best way to play it is through precious metals exposure. And hence, there's definitely upward scope for gold.
Some of the gold bears, the counter-argument has always been, even given the price appreciation we've seen, it's a non-yielding asset. Does that matter to you at all?
Not really, in the sense that I suspect what we're seeing at present as well, if you look at sort of debt deficits, you can buy sort of longer dated bonds anywhere in the world, but the question is, will you be repaid, right? So you might get the yield in the short term, but do you necessarily get repaid your principal? Because let's face it, we are in an era of astonishingly high levels of debt, particularly for developed market currencies or developed markets. And so gold does offer a decent hedge on that. And I suspect that the narrative on gold this year will shift towards one of portfolio diversification, both for institutional and for retail investors.
Okay. The non-shiny parts of like the metal space, right? I mean, if I look at tin or look at copper, for example, those are still. I mean, are the sort of the fundamentals and what you're seeing in the technicals, is that the same sort of thing that you're seeing in precious metals, or?
I'd say slightly different, Yvonne. I think certainly in copper, the long-term story for copper is very clear. We've massive electrification demands, around the world. You've got limited and I would say declining supply. It's kind of a one-way trade over the longer term. You could ask some analysts will say it's a bit overbought, it's a bit overdone at current levels, but I think the issue this year is that, unlike in 2024, China's not really going to be able to sit this one out, right? They're going to have to buy. And it basically says to me that over the coming year, we're likely to see copper trading higher. I've no doubt about that. It's definitely a buy in dips. If I saw it towards 12,500 per ton, I'm buying there.
Okay. There's certainly an FX overlay here when the debasement trade coupled with this sort of, just to borrow the sovereignty analogy, this grab for real assets, right? And in this case, of course, markets looking at commodities, whether that's industrial or precious metals. What does that tell us about near-term direction of the dollar, given the year it had?
Sure.
And longer term, how do I need to be thinking about dollar as a store of value?
Okay. I think if we look at the dollar, we've had roughly a 10-12% depreciation since sort of January of last year. So year on year, we're lower in the dollar index by about 10-12%. And that's from what was a multi-decade peak. So the dollar still screens as being extremely overvalued, on any metric you look at. We know that the Fed continues to cut rates. We've still got this ongoing sort of twin deficit in the US, in excess of 10% of GDP. Historically, when the U.S. current account deficit has been larger than 4% of GDP in the middle of a rate-cutting cycle, it does tend to weigh in the dollar. And finally, you've got a U.S. administration which itself wants to have a weaker dollar, and they're actively moving in that direction. So I suspect that once we have some clarity about what's happening on the geopolitical front vis-a-vis Greenland, the attention then will turn back to, okay, what are we doing vis-a-vis the dollar, global monetary setup, etc. And that's where we're going to be in the second half of the year.
The reaction on the euro was quite interesting on the Greenland sort of headlines, right? It actually rebounded and actually became stronger. Is that more of a dollar problem, you think, than a euro one, this whole situation?
Well, I think the issue really is that, the euro is a current account surplus currency, right? And so which by definition means that during periods of extreme risk aversion or capital repatriation, it tends to appreciate, right? And this is obviously a US and Euro-centric issue. I think it's probably far too early to say what the effects of this is going to be in terms of market impacts, etc. I think the Trump administration are rather silly in how they're approaching this discussion with this kind of megaphone diplomacy. It's very rarely successful. And they're also giving the Europeans very little room for maneuver, right? So, it's like in China, as you know, the concept of saving face is super important. And in that context, look, I think that the Europeans have to react. We'll see. They're trying to tone it down. We'll see what happens at Davos this week. But overall, I think that the negotiation style they're using could be a lot more intelligent in the States. It doesn't strike me that it's conducive to getting a good outcome.
People are trying to figure out how firm Europe will get. I think you bring up a very good point that it is a current account surplus currency, which means they are, I guess, in some ways beholden to trading partners, right? So whether that's Germany maybe looking to be on the softer side because if it's the U.S. is an export market, so is China as well. Does the economics trump the geopolitics? In the end, do you think that Trump will get likely what he wants just because of just the reality of the economics on the ground?
I think that's what we did see last year, right? When Trump moved on the first round of tariffs against the Europeans, they rolled over. And it was quite interesting because the European Commission apparently was ready to retaliate with pretty severe sanctions, pretty severe tariffs. However, the country heads themselves kind of said, no, look, we'll accept the deal on offer. So it does appear to me that last year the economics trumped the politics of it. Yeah. This is a slightly different issue. This is more one around sovereignty, and I think in that case, I can't see how they can roll over so easily this time around.
You haven't talked about yen yet. I have to ask you before you go. I mean, we're approaching 160. Is that going to be the line in the sand, you think, for any sort of intervention?
You would think it would be. I think the issue really on any intervention, for it to be successful, it's got to happen in the context of a weaker or weakening dollar, right? And what we've seen in the previous years when they've kind of intervened, that they were kind of fortunate, I would say, when they intervened, and the dollar weakened a little bit afterwards. The issue this time around, I suspect, for the BOJ is that the level of interest rates, they're gradually getting it higher, but they're not doing it at a speed which is enough to really shift the dial for investors, right? Yeah. And that's why you can see that's why dollar yen is trading way above levels which would be implied by the 2-year or the 10-year swap spread, right? So the yen is astonishingly cheap. We all get that. The question is, what's the idiosyncratic catalyst to see it much stronger? And in the absence of an intervention, I struggle to see what it is. I think a lower dollar yen story is really a dollar story at this point, right? And that's kind of how it strikes me.
Peter, it's great to have you in town.
Thank you.
Thank you. Peter Kinsella there, Global Head of FX Strategy and Head of Investment Services UK at UBP. Coming up, Vietnam holds a high-stakes political gathering as the ruling Communist Party picks new leadership amid tariff negotiations with the U.S. The latest from Hanoi next. This is Bloomberg.
Right, welcome back. We're looking at Vietnam. The equity market just coming online 0.5%. A little bit of strength coming through there in the equity markets. Flat to slightly softer there on the dong, as you can see. Well, stronger on the exchange rate at least. Mixed as far as the big stocks are concerned. There's a political exercise that's taking place. In fact, let's get more on that.
Yeah, there's new growth model. They're also aiming for 10% growth. That's some of the headlines that have been crossing so far this morning. And let's get more, of course, on this National Congress and To Lam's address with our Hanoi Bureau Chief, Francesca Stevens. Francesca, it's good to see you. Walk us through what's really happening this week.
Thanks. Yeah, well, as you say, Party Chief To Lam has been at the podium and has just wrapped up speaking at the opening ceremony for the National Congress taking place in Hanoi. He's been talking about the need to form a new model for growth and also sees room for faster and sustainable growth. And he's also reiterated the target of at least 10% growth for this and the next few years. He's also touched on the need to boost foreign relations, defense and security. So at this Congress, he's aiming to secure a full 5-year term in the top job and may also be put forward for the presidency, which would be a rare grip on the top two levers of power and would represent a major political victory for Lam if he does manage to secure that. Well, over the next few days, just under 1,600 party members will vote for the Central Committee, which in turn will select the Politburo, and from that, the General Secretary. They'll also then make nominations for the top government positions. That's the Prime Minister, the Presidency, etc. So we'll find out who has secured the party chief position later this week, and it will be a big surprise if it's not Lam. What's less clear at this stage is if he will also secure the nomination for the presidency. So we'll not find this out, we think, until after the Congress when the Politburo meets for the first time. But in Vietnam, anything can happen, so things can change at very short notice.
Yeah, absolutely. Francesca, beyond the short term, let's say even just beyond the next day, the next few hours, what is To Lam trying to achieve?
Yeah, look, To Lam has made a name as a big reformer in the roughly 18 months that he's been in the top job since the death of the former party chief. He's pushed through some of the biggest reforms in 40 years, slashing the size of the bureaucracy, shrinking the number of provinces by half, and cutting a whole tier of local government, putting thousands of bureaucrats out of jobs. So this will be a chance for him to secure the backing for his mandate and keep on that reform path. Delegates are also expected to sign off on a new 5-year plan. It's a one-party state here, so we don't expect there will be much divergence from the current policies, but we will be looking closely at the language when it comes to the private sector and state-owned sector and what that signals for spurring growth. The Congress comes at a crucial time for Vietnam, which is still negotiating its tariff deal with the US while also balancing relations with China. So we'll also be looking out for signs of foreign policy shifts. Plenty to watch this week as it unfolds. It runs through to Sunday, but we could get an announcement as early as Saturday.
Francesca, thank you. Francesca Stevens there, our Vietnam bureau chief, joining us out of Hanoi, of course, this party or National Congress is underway. We also have a press briefing out of China that is underway here as well. This is the NDRC briefing. This is the first of two to look out for today. So what we're hearing from the NDRC deputy head, Wan Jianling, he's talking about addressing bottlenecks through innovation. So once again, there is this sort of, leaning towards high-end manufacturing, the like, to really kind of help with the economy and also to make a strategic plan to expand demand from 2026 to 2030 as well. I mean, those are the only headlines really crossing so far, Dave, but what do you make of it so far? Yeah, well, it certainly is consistent with the broader objective of trying to get consumption up and technology as being central to increasing the output, right? So we'll really need to see, of course, more details from this, but that is just to say, of course, it is just the beginning of of this next 5-year plan, and certainly we'll keep on top of this. Markets maybe just doing the opposite. That's maybe down to other things more than what's happening specifically in Beijing at the moment. This is Bloomberg. Welcome back. Here are some top corporate stories we are tracking. A lot of moves in the Chinese corporate space. So you have NetEase Cloud Music says it has struck a deal to distribute Universal Music Group's global recordings across its streaming services and affiliated digital products. Now, the catalog includes Chinese and international artists that are signed and distributed by UMG labels. Now, the agreement also includes artist-centric provisions and terms covering AI. Now, Point72 Asset Management has signed a deal to take more space for its upcoming office in a skyscraper in Hong Kong's Central District. Our sources say the U.S. hedge fund firm is now taking 85,000 square feet across 7 floors of the Henderson. Now, despite growing demand, of course, for Hong Kong's high-end commercial buildings, CBRE still expects the city's office rents to drop 3% this year. Now, Bloomberg has learned that Tencent and Fidelity International, and Temasek as well here, are planning to invest in the Hong Kong IPO of Chinese snack retailer Biziming. Now, we're told they're poised to be cornerstone investors in an offering that could raise as much as $500 million. Biziming, still hard to say that, is planning to start taking investor orders as soon as Tuesday. Okay, Biziming. It doesn't quite roll off your... You're busy It was a busy day.
I'm busy Ding.
No one gets that. That's his nickname, Ding, by the way.
Such an internal joke.
All right, we're watching markets.
We're busy bees, though.
Yes, definitely busy bees. And it looks like right now when it comes to, the tech stocks are selling off.
Just a drag.
Quite a bit here, just given what we've been seeing with Greenland, the like. So still seeing a bit of flare of risk off here across these markets here as we continue to track what happens in Europe and Greenland. We have plenty more coming up. This is Bloomberg.
To the people in Japan, as the Prime Minister, today I have decided to dissolve the House of Representatives on 23rd January. After dissolving the House of Representatives on 23rd January, the campaigning will start on 27th January, followed by the general election, which will be held on February 8th. I plan to hold the election immediately as such. I, myself, am staking my career as Prime Minister.
Prime Minister Sanae Takaichi there of Japan setting a date for, of course, the snap elections as she seeks to strengthen her mandate and secure a lower house majority for her ruling coalition. But mark the date. February 8th is now been confirmed. In terms of Japanese markets, we continue to see the selling off of the long end of the yield curve here. We take a look at when it comes to the 10-year. We're off about 6 basis points to the upside there. There's a 20-year JGB auction as well. So we'll see against this environment what demand looks like, if any, when it comes to long end JGBs. And dollar yen, we're still sort of on the weaker side, but of course the dollar moves of late have at least we stabilized the currency at 158 levels here right now. But yes, depending where you look at in the curve, we continue to see a melt up.
Yeah, so that's 10 all the way to the 40-year. For the first time since 2007, we have a 4% handle on the 40-year. The auction today, and I'm just looking for the headline here, 800 billion yen is an offer today. So with the exchange rate at let's call it 160, that's about $5 billion worth, roughly, just over $5 billion in dollar terms. But yes, keep an eye on that. That should be out, details out in the next hour or so. Okay, is there good value in the JGB markets given the melt up in yields and at these levels? To help us answer that, Jenny Zeng, Fixed Income CIO at AllianzGI, is here with us, of course, and said, Happy New Year. Very nice to see you.
Happy New Year.
Would you be a buyer of JGBs?
Well, it looks like emerging market, isn't it? Everything is selling off. When it sells off, it doesn't behave as OECD countries. So that's the interesting part. I think when we look at the JGB, the interest, it's probably one of the anomalies that the market we're seeing right now. Because if you think about it, the Japan has a structural deflation for decades. Right? And then they suffer from a lack of domestic investment for a very long time. From a Takaichi's perspective, she would say, okay, now what? Why don't we just create a condition that we can stimulate domestic economy and domestic growth? And if at the same time inflation runs above the target for a prolonged period of time, so be it. Now, so that means that they will need to spend more physical stimulus, physical spending, right, to create a reflationary economy and to bring growth back to Japan. Now, the interesting thing about Japan is, apart from other emerging markets, it's not an emerging market, right? It's still an OECD, it's not at all. Now, the interesting part about Japan market is that they have a lot of excess savings. A majority of that excess savings are invested overseas, in dollar-denominated U.S. equities, emerging market debt. Now, what if, for whatever reason, people's physical concern, the investors' concerns on physical conditions, and but if the yield curve is high enough, as you said, this is the 4% we hit here in 2 decades, right? Yes. The highest. So when will that money start to repatriate? I think that can create a shock, not just for Japan, not just for JGB, for yen, but for the entire financial market. I think that's the power of Japan.
If you consider hedging costs, which obviously dollar investors need to take into account, right, when they look at the yields, and looking at where rates of the BOJ will likely be. So they've said they need to raise interest rates. We don't know when, but we know roughly what it would take to make yields positive again, real rates positive, right? Do you think we are going to get to that point over the next 12 months, given all those factors that dollar investors need to start looking at repatriating back to Japan?
I really think it's a risk that's very underappreciated because now in the market, the mindset is, BOJ will always be behind the curve. Yeah? Right? That's the mindset of the market. That's why no matter how even we see that the interest rate differential between Japan and U.S. has closed, but still yen continue to weaken because people think that BOJ will be very slow and gradual. Yeah? But what if now we see real physical spending in the economy? Then naturally that can accelerate and the BOJ will feel more comfortable hiking going forward. So yes, so that could be and again, if we started to see that and if we started to see repatriation of money from overseas to onshore, we will see yen higher, we will see maybe even JGB supporting JGB, and then we will see selling off everywhere else.
Yeah. Should I just assume that term premium is just going to reprice higher?
Yeah.
I mean, we've seen that fiscal policy is being a bigger driver of that now.
Yes. But at the end of the day, it's a very indebted economy.
True. Yeah.
Right? So we will see probably, again, if that happens, we've seen a little bit of that in last May. When we see that repatriation, the sell American, thing. We started to see the playing a little bit now, right, overnight. Yeah. So if that happens, I think most likely is that you express that via the currency. Your shorter end perhaps is more supported, but you still have a steepening curve.
With credit considered, so let's say fiscal discipline is driving sovereign yields up. Spreads are very, very tight, right? Yes. Especially in high yield, investment grade, especially.
Yeah, everything.
So where's the value in absolute yield, or because spreads don't seem to be telling me there's value there?
Well, if we look at much longer term when investing in credit, starting yield is always a better indicator for future returns. Now, again, we have been talking about credit spreads, how tight credit spreads has been for God knows for how long, right? Just getting tighter and tighter. Yeah, just getting tighter and tighter. But we think what was supporting that last year will continue this year. Attractive starting yield, the decent fundamentals with the default still in check in the public market, right? And very strong technicals. We still have more than 7 trillion of money sitting in money market that can be reused in the credit market. So that's still there. That's still central, front and central, that thing. Exactly. So we still think that, plus with accommodative financial condition overall, you still need to be long carry. It's too early to give up on carry. You still need to be long carry. But you go up credit curve. Yeah. So, focus on security selection, country sector rotations and things like that. And also at the same time, your expected return this year should be slightly lower than last year because we know that it's more likely for spreads to slightly widen than tighten further. So what you get is the yield, and you have slightly widened credit. So your overall total return probably will be slightly lower than last year, but will still be a decent year.
How should I look at AI now across credit markets?
Yes, but last year most credit investors are sitting on almost were sitting on the sidelines. It's more like an equity story, right? But I think this year credit is going to become much more a center in terms of the story. We've seen this many times. It usually started equity funding, cash flow funding, operating cash flow funding, and started to go to the IG market, high yield market. So I think the credit market will play a much more central role. Now, this is the thing we have been telling our investors. No matter it's AI companies, and in the past, the telecom companies, the Chinese property companies. We've seen this many times. I'm not trying to make a comparison here, but we think investors should approach any sectors as they approach everything, right? The AI, just make sure that you understand what's going on with the company, what's the balance sheet evolvement, what's the credit trajectory, instead of emerged into this fear and and FOMO and things like that. Be selective. And fundamental driven.
Yeah, selective amidst all this massive issuance that we've been seeing around the space there. Jenny, thank you. Jenny Zeng there, CIO, Fixed Income at AllianzGI. There is a story that just popped through my inboxes and, of course, the terminal.
Oh, wow.
This is a scoop from our team in China talking about PDD. This is Pinduoduo, of course, the e-commerce platform. So China has, according to our sources, broadened this probe into PDD after its employees exchanged blows, we're talking fist fights with regulators and really dispatching over 100 investigators from various agencies to the company's Shanghai headquarters in recent weeks. Now, we have heard about the special investigation team comprising of regulators from agencies including the SAMR and the State Taxation Administration to carry out extensive on-site checks. This is according to people familiar with the matter. So obviously, this is a very sensitive issue, but this investigation has been triggered, of course, by some of the exchanges that we've seen between employees and regulators last month.
Yeah, exchanges is a very light way of putting that. But yes, and I think to the point that this is something we'll track going into the U.S. session, right, in terms of just the listing. I just had to look at shares. We're down about 6 straight days, and our story has had about more than 12% drop since January date. More details coming on this, plus plenty more. This is the China Show.
Let's do more on that scoop we just brought to your attention here when it comes to PDD. Now, China is said to have broadened an investigation into the company after some of its employees got into fistfights with regulators. Our Greater China senior executive editor, John Liu, is here with more details on what we know so far, John.
So the latest development that we are reporting today is that this investigation that started, that was the catalyst for which was that fistfight in Shanghai in December, has now expanded to include a broader array of regulatory agencies. We understand that upwards of 100 officials from spanning the State Administration of Market Regulation, which looks after anti-monopoly, anti-competitive practices, and also to the tax authorities. There's a cross-agency team that's been formed, and they are investigating, taking a closer look at all of PDD's operations.
Is this just a PDD story, or is there something beyond that investors need to be considering if that is indeed the case?
So our understanding right now is this scrutiny that PDD is under is linked to the fistfight that we reported earlier in December. And so in that sense, it is an idiosyncratic PDD-specific situation. But I think we should also remember this is coming after Trip.com, sort of said that they are under investigation. There has been more regulatory measures taken when it comes to pricing for everything from cars to delivery. And so
platforms.
And so, although I think it is idiosyncratic to PDD, I think it's like another sign that there is more sort of conscious effort to try and get a better handle of how the market is running.
I mean, this is a company that basically its ascent came after the antitrust probe on Alibaba in some ways. The scrutiny from this regulatory body, the SAMR, carries particular weight. Can you tell us a bit why?
So SAMR, they're in charge of how different companies in any specific market compete with one another. And if any specific company is doing something they shouldn't be doing. And so I think it's interesting and noteworthy because they were also the agency that went in looking at Alibaba, at Tencent, all of these big tech companies back, in 21, 22. And so their involvement, again, I think, would cause concern, especially for investors in PDD.
John, thank you so much for the context. John Liu there, our Greater China senior executive editor there. On this specific one, of course, in particular because of the fistfight in December, the broader conversation is, of course, market behavior, anti-involution, and really just this fierce competition we're seeing really across multiple sectors. Okay, just crossing as well. It's busy, as we wrap up the show. Okay, so we're now looking at, this is soybean purchases that China, up until this point, I believe, has been able to close to meet the U.S. pledge. So China's purchased roughly 12 million tons of U.S. soybeans in the last 3 months. That is according to some traders that our colleagues have been able to speak with. But apart from that, nothing else. Does anything stand out to you so far?
It's significant because they're honoring their side of the trade deal, right? Which was to buy more U.S. soy. There was some concerns in the market last year when this deal was struck, whether China has the means to buy that much. Is the demand really there, given that they really stockpile a lot from Brazil or before that? But certainly it seems like they've reached at least that milestone. That sort of date that was supposed to be by 2025, that deadline was later shifted to February of this year. So it seems like they have been able, just in time before February hits, to reach that 12 million tons of U.S. soybeans. So it could be, just a sign of this trade truce does continue in some ways, that China is still in some way honoring that as well with these commitments here. But obviously a lot also has happened geopolitically here when it comes to Venezuela, when it comes to Iran. Certainly there's going to be a lot of questions on where the U.S. and China relationship still stands right now. This is Bloomberg.
Well, we're talking about K-pop, number one, because I think Blackpink is coming to town, if not already. I saw some people. Soon, right?
Yeah.
Well, there's one person that's not going to be there.
I make it sound like I'm going. No, I couldn't.
Oh, I wish I could get tickets. Okay, no.
Someone's got a spare one.
Yeah.
Please
send them, not my way. K-pop is also in the Korean stock market, which has popped quite substantially, up 17% despite the drop. Even after the drop, we're seeing this almost every single day, with the exception of this morning so far, that the market has done well. Do we get to 5,000? That seems to be easy work from this level. Do we get to 6,000? That's certainly what the Korea Exchange thinks we'll be at. This world-beating rally. We'll take the index there. Have a listen to what the Korea Exchange had to say.
I think the KOSPI can extend beyond 5,000 and towards 6,000. Since the year before last, we have made efforts to increase shareholder returns through various programs, which have been supported by the government through policies and legislative revisions. Recently, South Korea's main industries, such as chip, defense, and shipbuilding, have been more competitive, which appears to have led to a new value up for the Korean stock market. It's nearing 5,000, but I think beyond that, even 6,000 is possible.
Now let's talk about trading hour extension. So Korea Exchange said this week that it's going to extend trading hours to 24 starting the end of 2027, and it's going to introduce 12-hour trading starting this June. Why does Korea Exchange have to pursue this extension of trading hours?
In light of these global trends and also to attract foreign investors, I believe expanding trading hours is inevitable. While monitoring the transition to 24-hour trading in the US this year, we believe we should move to a 24-hour trading system ourselves by at least the end of next year. Doing so would help attract overseas investors and ensure greater alignment with global market standards. As a transition, we plan to start 12-hour trading from June.
The won's weakness has been a big concern for South Korean authority, and once South Korean stock become a lot more attractive than now and have retail investors come back to the domestic market, do you think that can help stop won's weakness?
I think it would absolutely help. From a macroeconomic perspective, despite Korea running a sizable current account surplus, I believe the fundamental reason the won continues to weaken lies in the capital account. The first factor is the outflow of foreign currency driven by corporate overseas investment. The second is capital outflows stemming from domestic investors' investments in overseas assets. Together, these flows have been a key driver of the weakness in the won. In that context, the impact of portfolio investment on the exchange rate, often exemplified by so-called global ant investors, could begin to normalize as domestic investors return to the local market, and more importantly, as foreign investors increase their investment in Korea. I believe that process could serve as a catalyst for stabilizing the currency exchange rate.
When you said a few years, South Korea will be able to get an upgrade to the DM index with the MSCI, and how soon, a few years, do you mean?
The president aims to join the Developed Market League within his tenure. So that appears to be the final target that South Korea should pursue. It might take a few years, as it takes 1 or 2 years before the final reclassification is determined after joining the watch list first. Even if we start the process right now, the procedure will take several years.
And there are also concerns that the upgrade to the DM index would actually trigger funds outflows. What's your thoughts about these concerns that the upgrade may not be necessarily a good thing for the South Korean stock market?
Fundamentally, global capital is far larger than domestic capital. It's so large, the two are hardly comparable. If Korea is reclassified from an emerging market to a developed market, there will be mandatory allocation requirements for global capital. Therefore, I believe the inflow of capital will be substantially greater than the outflow.
Let's talk about some of the issues related to Korea discount. So one of the priorities that the Korea Exchange have is delisting the so-called zombie firms in market and accelerating the delisting process. Why is this important to resolve Korea discount?
About 2,800 companies are listed in South Korea. In the US, about 5,500 companies are listed on the New York Stock Exchange and the Nasdaq. The US GDP is about 15 times bigger than South Korea, while the market capitalization is 30 times larger. But the number of listed firms is only 2 times bigger. If you do the math, the market cap of individual firms in South Korea is about 1/15. In that sense, we think too many companies are listed in South Korea. In the future, these zombie firms must be forced out quickly to restore market trust. These unprofitable companies are easy targets of stock price manipulations and other unfair trades. To enhance confidence in our domestic stock market, we should do speedy work on rooting out zombie firms.
That was the Korean Exchange CEO speaking exclusively with Bloomberg's Yoo-Kyun Lee in Seoul. We're checking the power, not with us, or not with Korea, but really power stocks. Electric stocks are surging. There was this report on China's southern power grid. They're planning 180 billion yuan investment for 2026. So that really kind of sent some of these electric stocks higher with a bit of a shock, it seems, to the upside.
Shock to the system, all the way up. I do feel kind of low energy. Did you sleep well last night? I didn't sleep well last night at all. I had a very strange dream, which I'll tell you about later on. This is not for...
It's not appropriate for TV.
Actually, no, it's kind of weird. It's just that the characters involved, and I rarely remember my dreams, actually. This one, I woke up and I vividly remember, like, what was that person doing there? And then I woke up feeling tired. So you kind of know you didn't sleep well because you kind of remember what happened.
Okay.
That's just me
I hope I wasn't in that dream.
No, actually, no, you were not. I guess our team is quite curious.
Hey, JGBs are selling off. Let's take a look at that.
Yeah, the thing is, I don't have a lot to say about JGBs, so I'd rather talk about my dream instead. But I think we achieved our objective here is buying time as well. The question is, how much time can you buy with this melt up that we're continuing to see in the JGB market? At what point do you get value on the table? We're nearly at double-digit increases now on the yield on the 40-year, as you can see, well, just about across the curve. Very quickly, Europe's still a big story. A glance at assets going into the session there. Big drop yesterday, and we'll end, of course, our day with a look at MSCI China. We're down now a 4th day. That's it from us. We will see you all tomorrow for our midweek show. Plenty more ahead here on Bloomberg Television.